Hiya guys, just wanted to focus today on the different types of conditions in the markets. And the first thing that I do in the morning is I make a judgment on the type of market conditions that exist in the markets that I'm trading. And you can see from the chart here, this is the DAX index on Friday, 5-minute chart here on the left hand side, 1 minute on the right hand side, and this is today, which is Monday, 2nd of September, and these two are the same. This is the 5-minute chart, this is the 1-minute chart, that's Friday, this is today, Monday, this is the 5-minute chart, this is the 1-minute chart, and you can see the difference in the charts. And this today is what is typically known as a choppy market. It's up and down, up and down, up and down, up and down. It's gradually, the market's creeping up. It's in an uptrend, but it's so gradual and it's choppy, and it requires different tactics to this, which was Friday, where we had a big uptrend. And what I want you to do is I want you to start thinking about, you can't just have one trading strategy and operate it in the different market conditions and expect it to work, because it won't. The chances are it won't. Professional traders tailor their trading to the market conditions that exist, and here's why. Friday you've got a big uptrend on the 5-minute chart, and look at the difference between these two figures here. These are 20-point gaps, 20-point gaps. So this was early in the morning, this was 8 o'clock in the morning through to 1 o'clock in the afternoon, and the market went up from 11,840 to just about 12,000. Okay, so 160, there's actually 140 points within that period of time. Moving back to today, this is 5 a.m. There's the 8 a.m. start, big move up on the 8 a.m. start, but 5 a.m. through to 11 a.m. same sort of time scale, and the market's gone up by 45 points. So that's a big difference, and that's the average true range for that 4-5 hour period, and that's reflected in the candlesticks as well. Okay, yeah, the 8 a.m. candlestick was huge, but it was only huge in comparison to what had come before it. And so you should be looking at this and thinking, this requires different tactics to this, and it does. This is an uptrend, and the market is breaking out upwards every time. There's a trend line down, slight downward leg in the market coming up to the open, and when it breaks that trend line, it zooms up, it breakouts easily and smoothly upwards. There's a bit of consolidation, and as soon as the market breaks that consolidation on the upside, it breaks out again here, slight trend line there, breakout upwards, and again consolidates, comes back to the exponential moving average, which in this case is the 8 exponential moving average, and so it consolidates above the 8 exponential moving average. You get a double doji candlestick pattern there, which is fantastic because that's exactly what I'm looking for, and the market breaks out upwards. And every time the market gives a good candlestick pattern and looks like it's going to break upwards, it does in an uptrend like this. Every time the market comes back to one of these exponential moving averages and gives a good candlestick pattern, I can go long and know that there's a good probability that I'll get a good risk and reward trade out of the market. And looking at the 1-minute chart here, I very often look for my candlestick patterns on the 1-minute chart. I know I'm in an uptrend. This is 11.15, so it equates to joining it about here. So the market comes down, hits the 20 exponential moving average here on the 5-minute chart, which equates to roughly the 90 exponential moving average on the 1-minute chart, and you get a good reversal there, and we can go long. Comes back down, you get reversal patterns here, 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 and every time you can be confident that you're not going to be the only one going long. There are going to be more people, more bulls in the market than there are bears, more money going long than there is going short or selling, and the market is confidently moving upwards until it reaches a climax here, consolidates, you get a double top, and the market goes down. So take 5 candlesticks, every groups of 5 candlesticks, and work out, what does that equate to in terms of the movement in price? 1, 2, 3, 4, 5, that's 10 points. And I'm looking for a minimum of a 10-point run, a 10-point leg. I'm looking for a minimum of that because that's what I require based on the risk that I have to take to make sure the market doesn't take me out on my stop. I need to have between 5 and 10 points for each one of the risk that I'm taking for each trade. I need to have that as a minimum for my reward. And when you take into consideration on this particular market, this is the DAX again, the spread, the charge is 1 point with my broker on this particular market. And so if you're only getting 5 points in profit, then, and one of those points is the spread, then you need to have a very efficient system or a good win rate. You're looking at 70% win rate to start making money. And so the percentage of the fee to the target is important, and a 10-point target with a 1-point charge, the charge is only 10%. It's not going to make that much difference, and therefore your winning percentage needs to be actually lower and still make money on this particular strategy. If you've got a 5-point target, the 1-point spread makes more of a difference to your profit, and your win rate has to be higher. I hope I explained that properly for you. Anyway, you'll be getting the picture. We've got to look at these differences here. These are 20-point differences. Every time the market broke out on Friday, it went up at least 20 points in the next spurt almost. And then you look at today, and every time the market looks as though it's going to break out, so this is a high, tries to break out, reverses, and that'll have trapped traders in. Market breaks out, reverses, again traps bulls in. Bulls are trapped, and the chances are they exit their positions for a loss down here somewhere. And this is the game. It's a game, this, and it's a game that's played by professional traders. And there are ways of trading. This is a trading range. It's low, average, true range. Each one of these gaps here is 5 points. And apart from the big move up on the open, every time the market breaks out, you get about 5 points, which isn't enough. So you shouldn't really be looking for breakouts in this type of market. You've got to look for entries. If you want to trade these conditions, you've got to look for entries at good value, which means buying low, buying down here and taking your profits up here, buying down here, taking your profits up here. And if you look at this particular market, look on the 1-minute time frame, every time the market has reached or nearly reached a low, when it comes down here, nearly reaches this low, you get buying because the market's going up, and it goes up and it nearly reaches the high and then comes back down. And this will be trapping people out right, left and centre. There'll be bulls and bears making losses in here, and the professionals making money because they will buy down here, sell up here. And that's what the majority of traders majority of the money anyway in trading is doing on this particular market, is buying in good areas, selling in good value areas. And again, the EMAs are playing a part. This is the 90 EMA wandering upwards here, and every time the market's come down to it, the market has reversed and gone up. But can you buy? Can you buy here? And what can you buy here? Did anybody make any money here? If you've got to wait for this candlestick, this pin bar candlestick here, at least to come in, and then let's say you enter at the top there, you got 5 points. Well, that's there's a 5 point risk and a 5 point gain. You've got to have a good win rate, and you've got to be blooming accurate to get out at the top. Otherwise the market comes back and probably you get a little bit concerned it's going to go down, big red bars there, and you exit for a loss. And that's the way trading ranges work. You have to understand and tailor your system to the type of market conditions that exist, not what you hope for, which is big breakouts, because there aren't any. Market's broken out here. What did you get? 5 points. Not enough, and you'll end up break even at best trading this type of market, unless you're very precise with your entries. There are good candlestick patterns appearing everywhere in here. That's a reversal candlestick pattern. That's number 1, and our reversal candlestick patterns again 1. Again, there's a reversal candlestick pattern there, number 1, number 5, number 3 there. They're all over. There are double tops, double bottoms. There's a double bottom there. There's a double top up here, double bottom there. That did actually work out. That one did actually work out. That one didn't work out. And so you need to tailor your trading according to the conditions. And I have a look. I always have roughly the same number of candlesticks on my charts. You've got 5-minute chart here. It's about 5 hours on there. And on the 1-minute chart, there's about an hour and a half, something like that. So, you need consistency in what you're looking at to notice differences and to notice similarities. Your brain's really good at noticing patterns, and it'll only see patterns if you keep things consistent, which means keeping consistent charts like the indicators, the EMAs that I have on my charts. They're always the same. 5-minute chart sitting alongside the 1-minute chart, using the 5-minute chart as control. And I explain all of my methods in my courses, and there are ways of trading every market. You just need to notice and be able to understand what type of market it is. And one way is to look at the ATR. Look at these gaps. These are 5-point gaps on the 5-minute chart. This is the 5-minute chart. These are 20-point gaps. Every single candlestick, that is a 25-point candlestick. Even the small candlesticks are at least 7, 8, 9, 10, probably 10 points on most of these candlesticks. And that's good. That's good volatility. Breakouts are working. You can make money as a bull on those markets, and even the bears made money on this reversal here. Trend line, uptrend, trend line broken, double top. This is a reversal candlestick pattern as well, and as soon as the market goes below there, the bears are in. It's below the EMAs, the 20 and the 80 EMAs. Bears made money at last. And the reason the bears made money is because after such a long uptrend, the bulls needed somewhere to get out, and they all got out, or a lot of them got out here, and they waited until it got to a good value area, the R1 resistance pivot point here. You can't see it on this chart, but it's here, and then they went long again. Everyone went long again. The bears took the only profits probably of the morning, and the bulls went long. And so the dynamics of supply and demand work slightly differently depending on the volatility in the market, the average true range within the market, and that needs to be the first thing that you look at. You know, you have a look and see whether the market has gone up overnight, but check the volatility out and compare it to previous days, compare it to what the market you're trading has done in previous days with the same volatility. Has it gone into a trading range or has it trended? Have a look at that, because you're starting to get your brain will pick up patterns, it'll pick up a pattern, and you'll be able to devise some sort of system, some sort of way of trading the market based on the conditions that exist. If you want guidance with this, I'm happy to provide it. I hope this has proved useful for you. This is the horrible chart. Most people will think it's been horrible today because most amateur traders will have lost money in this mess here. Going long at the highs and short at the lows, and that's not the way to trade this type of market. You have to go long if you're going to trade. Most people would be better sitting out markets like this, doing something else. But if you're going to trade, you have to go long at good value when the market's gone down, and you have to go short at the tops. You can almost guarantee as soon as it gets near these highs here, there are traders, professional traders, going short, putting their stop up here, going short and scalping this particular market. And when they tried to go short here and it went up, most of them will have had a wide stop, so they'll probably still have made money as the market came back down. But that's the different styles of trading. Hope you found that useful. My name's Anthony Beardsall. Join us on one of our trading courses if you want more information like this and guidance. I also offer coaching, and so I hope you enjoyed it. I hope you get good value from it, and I'll catch you on the next video. Bye for now.